Welcome to the deep dive. Today we're jumping straight into American Eagle Outfitters, or AEO, specifically their Q2 Fiscal 2025 results and what they're seeing for the rest of the year. Should give us some key insights. So first things first, the big news. AEO reported its Q2 results, and, well, they pretty much beat expectations. The market definitely reacted. The stock was up over 20% after hours. That's significant. Let's look at the top line numbers for Q2. Operating income hit $103 million.
Yeah, which is up about 2% from last year.
Right. And total net revenue, $1.28 billion.
Which beat the analysts who were looking for, what, $1.24 billion?
Exactly. And diluted earnings per share, the EPS, that came in at $0.45.
Wow. Yeah, that's way higher than the $1.21 expected.
Really strong numbers across the board there.
And, these numbers are important, especially right now. The retail environment is, well, it's challenging. So exceeding expectations like this, it signals pretty effective management, good execution. Jay Schottenstein, the CEO, he basically said they saw an improvement driven by, higher demand, fewer promotions, keeping expenses in check, all things that actually beat their own internal expectations.
Okay, so it wasn't just luck. They were actively making moves.
Right.
So let's maybe unpack this a bit. Those overall numbers look good, but what about the individual brands?
Yeah.
AEO has a couple under its umbrella. How did Aerie and American Eagle perform separately?
Yeah, that's where it gets interesting. The overall comparable sales for the company were actually down 1%.
Oh, okay.
But that hides some differences. Aerie continued its strong performance. Comp sales there were up 3%.
Always seems to be the star performer lately.
It really does. But American Eagle, the main brand, saw its comparable sales decline by 3%.
Down 3%. So Aerie's growth is sort of offsetting the decline in the main brand, but not quite enough to get the total comp positive. What do you think is behind that dip for American Eagle specifically? Is it just tougher competition in that core apparel space?
I think that's a big part of it, yeah. Aerie has carved out a nice niche. American Eagle is competing more directly with, well, everyone in denim and casual wear. Product mix, pricing, fashion trends, it's a constant battle there.
Makes sense. Okay, turning to profitability then. The gross profit was $500 million. What drove that?
So the gross margin actually expanded. It was up 30 basis points.
30 basis points, 0.3%.
Exactly, to 38.9% year over year. And the main reason they cited was lower markdowns.
Ah, okay. Always a good sign.
Definitely. Means they didn't have to slash prices as much. Better inventory management, maybe better pricing strategy to begin with. Selling smarter, essentially.
Right, not just chasing volume. And what about other costs, SG&A?
They managed those well, too. SG&A expenses were actually down 1% to $342 million.
Down.
Yeah. So that discipline, combined with the gross margin improvement, meant the operating margin expanded, too, by 20 basis points to 8.0%.
So pretty disciplined on the cost side overall.
Seems that way, yes.
All right, so financially, things look fairly well managed internally. What about returning value to shareholders? Did they do much on that front this quarter?
They definitely did. They completed a pretty big accelerated share repurchase, an ASR, $200 million worth.
Okay. What does an ASR actually signal?
It's generally seen as a sign of confidence from the company. They're buying back their own stock quickly, often boosting EPS. This particular ASR bought back about 18 million shares. And if you look year to date, they've spent $231 million on buybacks. That reduced their outstanding shares by about 20 million, which is like 10% of the total diluted shares. Pretty significant.
Wow, 10%?
And on top of that, they pay their regular quarterly dividend, 0.125 per share. That's about $21 million going back to shareholders.
Okay, so buybacks and dividends showing confidence. Now, inventory. That's always crucial in retail. How did that look?
Inventory ended the quarter up 8% at $718 million. The actual number of units was up only 3%.
So the cost per unit is up quite a bit more than the units themselves. Why is that?
They pointed directly at tariffs. So the cost increase largely reflected the impact of tariffs.
Right, tariffs. That's been a persistent issue.
It has. And this 8% increase, it ties up capital, right? It also flags that ongoing headache of managing global supply chains and these trade policy impacts.
So are they just eating those tariff costs or trying to pass them on? Or maybe avoiding promotions like you mentioned with the lower markdowns?
It's probably a bit of all three. The lower markdowns suggest they're holding the line on pricing where they can, but tariffs add to the fundamental cost of goods. So they're trying to manage it through inventory, sourcing, maybe some price adjustments, but it's a tough balancing act.
Definitely sounds like it. Okay, so moving beyond the pure financials, the CEO mentioned something else as a key driver, especially looking ahead to the fall season. What was that?
Yeah, he really highlighted their marketing campaigns, specifically pointing to the recent ones with Sweeney and Travis Kelce. He said, fueled by stronger product offerings and the success of recent marketing campaigns, we have seen an uptick in customer awareness, engagement, and comparable sales.
So a direct link drawn between these big celebrity partnerships and actual sales results.
Exactly. He's saying these aren't just for buzz, they're moving the needle.
Let's talk about those. The Sweeney campaign, I remember reading they called it their best ever. What was the impact there?
It seems like it really resonated. It launched late in Q2, around July 23rd. The company said it led to uh, positive gains in new customers and sales. They actually quantified it 700,000 new customers.
700,000. Wow.
Yeah. And they saw consistently positive traffic across web and stores in August. Denim sold out. Traffic growth was double digits. They even had specific items like the Sydney jacket sell out in a day. Same for the Sydney jean, which had proceeds going to charity.
That's impressive velocity.
It is. Now, there was some chatter, maybe controversy around some of the campaign slogans and interpretations.
Right. I think I remember seeing some of that online.
Yeah, some definite blowback in places. But despite that noise, from a business perspective, AEO considers it a major win. Drove traffic, new customers, sales. Bottom line success for them.
Okay, so Sweeney was a hit despite the buzz. What about Travis Kelce?
That one seemed like perfect timing, almost. It launched literally the day after his engagement was announced.
Oh, really? Talk about capturing the moment.
Right. And the impact was immediate. They said it drove 3 times more sales in just one day than some past collaborations did in a whole week.
3 times more in a day.
Yeah, and items worn by Kelce and other athletes in the ads sold out very quickly.
So that cultural relevance, that timing really paid off. So putting these together, what does this reliance on big name marketing mean for AEO in the bigger picture?
I think it's pretty crucial for them right now. Consumer spending is still a bit soft. People are being selective. And the competition is fierce. Think Abercrombie, Gap, Levi's. They're all running major campaigns too.
Right. Everyone's fighting for attention.
Exactly. So these high-profile partnerships help AEO cut through that noise, stay relevant, especially with younger demographics, and acquire customers when wallets might be a bit tighter. It's about staying top of mind.
Okay, so Q2 was strong, driven partly by marketing and cost control. What about looking ahead? What's the guidance for the rest of fiscal 2025? And what headwinds are they still facing?
Right. The outlook is a bit more cautious, maybe mixed. For comparable sales, they expect up low single digit for both Q3 and Q4, which would mean the full year ends up approximately flat.
Flat for the year. But that's actually better than analysts thought, right? Weren't they expecting a slight decline?
Yeah, analysts were forecasting like a 0.2% decline. So flat is slightly better than feared on the sales front.
Okay. What about margins and income?
That's where the caution comes in. Gross margin is expected to be down for the rest of the year, Q3, Q4, and the full year.
Down year over year after it expanded in Q2. Why?
Tariffs, that seems to be the main driver. And because of that, they revised their full-year operating income guidance down quite a bit. They now expect $255 to $265 million adjusted. Previously, they were guiding for like $360 to $375 million.
Wow, that's a pretty significant downward revision. Primarily tariffs, you said.
That's what they're pinning it on, yeah. For the specific quarters coming up, they see Q3 operating income around $95 to $100 million, and Q4 maybe $125 to $130 million.
That tariff impact really hitting the bottom line projection then. You mentioned earlier they also had some merchandising missteps earlier in the year. Can you quickly touch on that again? What went wrong and are things better now?
Right. So earlier on, it sounded like they, maybe misjudged some fashion trends, had too much of the wrong stuff, not enough of the right stuff. That often forces more markdowns for its margins. Standard retail problem if you get it wrong. But the CEO's comment about stronger product offerings now fueling the positive start to fall suggests they feel they've corrected course. They seem to have a better handle on product assortment and inventory alignment with what customers actually want right now. Getting the product right is fundamental.
Absolutely. So product seems better, but back to those tariffs. What are the broader challenges there and how are they trying to manage it?
Well, the whole environment is just uncertain, right? They're actively working to reduce their reliance on China, aiming for under 10% sourcing from there this year.
That's a big shift.
It is, but it's not a complete solution because they have a heavy manufacturing presence in places like Vietnam and India, and they face reciprocal tariffs there too.
So diversifying helps but doesn't eliminate the problem entirely.
Exactly. Plus, they're still dealing with the overall consumer mood shoppers being more selective, cautious with spending on apparel. So it's this mix of global trade issues, supply chain adjustments, and trying to read a somewhat unpredictable consumer.
So if we connect all these dots, it really seems like a tale of two forces, doesn't it? You've got these really successful, high-visibility marketing campaigns, driving engagement, bringing in new customers, helping them navigate product better.
Like, definite wins on that front.
But then you have these persistent, large-scale macro factors, especially tariffs and maybe consumer caution, really weighing on the profitability outlook for the year.
That's a great way to put it. They can nail the marketing, nail the product, but these external pressures, like trade policy, can still significantly impact the financial results. It really highlights the complexity these global retailers face.
So thinking about the biggest takeaway here from AEO's quarter and outlook, it feels like it's this story of smart, maybe even edgy marketing really working to boost the brand and sales in the short term. But that success is happening against a backdrop of serious challenges from global trade policy and maybe shaky consumer confidence, which clouds the profit picture looking forward.
Absolutely. And maybe for you, the listener, the thing to ponder is this. How do companies like AEO balance those things? You know, the quick wins you get from a really hot marketing campaign versus the long-term grind of managing supply chains, tariffs, economic uncertainty. What other strategies could they or companies like them use to maybe shield themselves a bit more from those big external pressures while still keeping the brand exciting and driving growth? It's not an easy equation to solve.